Today, folks, your questions answered. Woo! Baby, let's go as we review my $400,000 Canadian dividend stock portfolio as we break down the top 30 positions by combining all of my ETFs, all my individual stocks to see what overlaps between the ETFs and break them down into the 30th largest positions. And if that is a conversation you'd appreciate, hit that like button because we're going to kick it off with some Q&As first, and we're going to finish with Q&As with some of the stocks in between here. But this is fascinating. I really love these conversations. And Chris B replied to my last video called the Six-Pack Portfolio, who actually inspired that video, saying, "Wow, Kyle, thanks for making this a video. I didn't expect you to make a whole video from my response, laugh out loud, but you're right. Making an extra 10 or 20% isn't really worth the risk in the end. I guess working with XIU and VDY are probably better options for safety. I wonder if you can speak more in depth on allocating a portfolio. How do we get a proper mix of ETFs and individual stocks and make it work? As for individual stocks, which ones would you take if you wanted to continue making those huge returns you did in the past?" Now, firstly, I don't plan on making those huge returns I made in the past because I don't have time to pay attention to stocks like I used to. Back then, I was a full-time magician. I had 5 days a week, and picking individual stocks was like my job during the week, and it worked exceptionally well. I mean, making no individual position more than 5 or 10% at most times, and obviously having the time to buy in and out of them when I thought deemed appropriate really worked to my favor. And now that I have like multiple jobs, I'm making 6 figures a year, I don't need to be chasing those super high returns like I was because I'm going to get that from my career. And I think most people that have full-time jobs shouldn't be really hand selecting companies if they don't have time to pay attention to them, get in, get out, and just, feel comfortable doing so. And FitBH says, "I can't speak for Kyle, but generally speaking, holding more than 10% in individual stocks can get you burned. I'd aim for a broad-based ETF or index fund to make up 50% of the portfolio and build from there." And I think that'd probably be the appropriate response for most people. But if I had to pick individual stocks, trust me, I still love the game of analyzing companies, especially companies people don't talk about as much. Obviously, there's TSM, there's things like ASML. I still love the chip sector. There's Evolution Gaming. This thing is outperforming Tesla here, and it's a fascinating European company that's kind of in the gambling sector. I'd still really consider looking at things like Apple. I mean, look at the 5-year performance; it's up almost 300%. Meta. If you had the guts to be buying the dip here and you just cost averaged, you would have seen a great return just in the last year, and even over the last 5 years, it's still outperforming, insanely well. And I think you could just easily pick, a small handful of these companies if you analyze them, pay attention to them. I think you would do just fine. But again, for me personally, I am just looking at sustainability of dividend income because I have a $400,000 portfolio that even if I can make 5 to 10% on a year, that'd be between 20, 40 grand a year that I could just focus on my job now at this point, which is what it's kind of come down to. And Rochester says, might as well sell TSM and put the money into VCE, VDY, VOO, and don't think about it and collect those dividends. And that's kind of the conclusion that I've come to. TSM, they recently just reported their monthly revenue and it dropped off way more dramatically than I thought, and I'm terrified for their guidance coming out in their earnings. So I did in fact scale it down as mentioned in one of my past videos. I got it out of my tax advantaged accounts. I took the profit, which was in total like a 20% gain or so that I put mostly into SCHD, and I'm still holding some of the position, about 10,000 worth actually in my corporate account, which I'm going to hold through earnings. But just taking a look at my TFSA first and foremost to show you that TSM isn't in here. So yeah, I did cost average. I got about 35,000 invested at book value in SCHD at this point. And from here, I'm just going to take the dividends from this account and I'm looking to put it into one of these broader based Canadian, broad-based ETFs, which we're going to talk about because it comes down into some of the Q&As. Now, I also did buy more SCHD in my registered retirement savings plan because I had $900 worth of contribution room, took advantage of that. I also had quite a few $100s in dividends, like a decent chunk building up. So I was able to put well over 1,000 US back into the SCHD, giving me about 111,000 now invested just in this ETF, with about 120,000 invested in VOO. So that's like my US investments. But let's get into the top 30 positions, taking all these ETFs from all my different accounts, because these are just my 2 tax advantaged accounts, and see how that proponently breaks down by stock. So getting into it, you can actually see the positions down below here, and it's broken down in this wonderful pie chart. And I really like this because it's really prudent to understand that when you're buying ETFs to not over concentrate, because a lot of stocks will overlap. And sometimes I feel like you can over concentrate if you're not careful with what you're doing, which could be detrimental. But taking a look, guys, my number 1 position now is Royal Bank at 5.8%. 50% of the entire portfolio thanks to the concentration it has in VDY. Toronto Dominion Bank in second place at 5%. And I think TD is probably one of the best buying opportunities with the amount of hate it has. It's not going anywhere in my opinion. I think it's just way too hated. So I'd be comfortable buying it here, even as an individual stock at a discounted level. You're talking about things like Enbridge. And, at my age, I could give or take Enbridge 3.1% of the portfolio. Happy with that weighting. Bank of Montreal, you got Canadian Natural Resources. And again, most of this is coming from VDY because it is super heavily concentrated. And I have like 150,000 invested in that ETF. So you can see why that's proponently making up some of the largest investments. Then we got Taiwan Semiconductors in here. You got Apple at 2%. And I think it's important when it comes to Apple and some of these tech stocks, I would prefer to have them upper weighted. And I do take into consideration my fiance's portfolio where she holds individual investments in Apple, Microsoft, Meta, and I take that into consideration with this portfolio, so it would upper weight some of these tech stocks if we're working as a unit. But we can see that I got Suncor in here at 1.9. There's Microsoft. You got Canadian Imperial Bank, BCE, Bell. You got TC Energy, AbbVie. This is where we're starting to see those SCHD companies from the Schwab US Dividend Equity ETF with Texas Instruments, PepsiCo. You got United Parcel Services, Verizon, Coca-Cola, Pfizer, you got Broadcom, Home Depot. Home Depot is an awesome company. Amazon, getting a little farther down there. Nvidia, Tesla. So we can even see I still have Tesla being one of the top 30 positions in the portfolio. Berkshire Hathaway, Alphabet, ExxonMobil, United Health Group, and then the rest basically makes up the other 50% of the portfolio. Now, it's important to note that about 60% of my portfolio is basically encompassed within the US, but taking a look at how the sector allocation breaks down, which is honestly a little more concentrated than most people would like, but I'm pretty happy with this, with financial sitting right around 30%. Ideally, my exposure rating I'd be more comfortable with would be around 25, but keep in mind this is because of the Canadian financial sector and because the Canadian banks comprise the largest companies in Canada and they are world renowned. They have survived multiple recessions. They are one of the most stable banks recognized globally. I'm not as concerned about that, but taking a look, we've got energy at 14.3% and then information and technology at 12.8%. Again, encompassing my fiance's portfolio would dramatically change some of these sector exposures because information would probably be the second largest instead of energy. But taking a look, they are still relatively balanced with healthcare at 8.8%, industrials at 7.8%, communications at 7.2%, consumer discretionary at 6%, consumer staples right around 6%, utilities at about 3.1%, materials at 1.9%, and real estate right around 1%. Ideally, it would be nice to get a bigger real estate portfolio. Again, fiance owns RioCan. We still got some REIT exposure. I do like Realty Income is another one that I'm fixated on a little bit. It'd be nice to get that a bit broader for some dividend income, but honestly, when it comes to growth outside of the real estate sector, there's been a lot better growth from some of these other industries like financials, especially in Canada, information technology. So I'm more happy with those being proponently bigger. And right now, I think energy is going to be the cushion to any major blow in the economy. In recessionary environments, typically commodities and energy tend to do a bit better. So I think that's going to give me a bit more recession-proof, performance. Just getting back into some of the Q&As, what I'm looking forward to buying in the future, and Patrick kind of nailed this on the head. He says you should compare VCE to XIU and XIC, all great options depending on what you're looking for. I have started diversifying into XIC. So the way I'm looking at my portfolio right now is proponently, I want one broad-based ETF like the S&P 500 or the TSX 60, the TSX S&P 60, the 60 largest companies in Canada, or a broad-based Canadian ETF, followed up with a broad-based Canadian dividend ETF and a broad-based US dividend equity ETF. So VOO, I'm matching with SCHD. I already have VDY for my Canadian dividend exposure, and then I'm looking at actually buying XIC and doing a comparable here. Again, I'm just buying XIC. I'm probably going to end up buying it because it's different than Vanguard. I already have a lot of money in Vanguard with VDY and VOO, so I'm looking to obviously get my money a little bit more institutionally diversified, and I can do that with XIC. But taking a look at the performance here, guys, this is just the S&P TSX capped composite, and the performance has been, nothing like the US, but for Canada, you're getting a great yield. The 10-year performance is pretty nice. If I zoom my head out of the way here, we can see over the last 10 years, you would have over doubled your money. In the lifetime of this index, I mean, you go back all the way to the early 2000s, so over a 23-year period, talking about a return from $10,000 to $43,000. So very healthy long-term returns, low expense ratios, growing dividends. The starting yield's apparently 3.17%. And again, you're only paying like 0.05% in a fee. And the holdings are pretty much the same as VDY, just a little bit more diverse and giving you exposure to growth companies like Shopify, because as mentioned, I do think Constellation Software, Shopify, these companies could continue to excel and eventually overtake some of these top holdings in Canada, because this is weighted the same way VOO is by market cap. So Royal Bank, Toronto Dominion, and Bridge are the largest companies currently in Canada. And just comparing it to VCE, I think VCE is just as good as obviously XIC here. So I was kind of on the fence which one I would pick, but obviously I think XIC for me is better just to get institutional diversification, because if we do scroll down, it's pretty much all the same holdings, just a little bit more concentrated in the top weighted companies. And then you obviously have the S&P TSX 60, and the only reason I don't like XIU as much is primarily just from the concentration. I mean, the performance is pretty much at par over the last 10 years. So you take a look, you would be sitting around what, 24,000. I think with XIC you're down just slightly below that, around 23,000. So not as good as performance, but pretty much exactly the same. I mean, it's almost dead comparable to most varying degrees. The yield on this one a little higher at 3.3%, but again, I don't think the yield matters as much because you're paying 0.15%. So literally, you know, from 0.05 to 0.15, you're paying 3 times as much on the expense ratio, kind of eating into the dividends, in my opinion. But again, very similar weightings, Canada's biggest companies. So again, I don't think if you were to just blindly pick one or the other over the long term, it's going to make a dramatically different effect on your returns. But for me, yeah, I do really like this XIC here. I think it's going to be one that I'll probably start putting my dividends into and probably start allocating to with new money, which you'll have to subscribe, and you can look forward to that in the future. But getting into this, guys, taking a look at FitBH again, saying, Kyle, can you make a video on how you would go about investing in the Canadian as a U.S. citizen or the Canadian markets? We do not have access to the New York Stock Exchange, to ETFs you have mentioned, things like VDY, VCE, XEI. Basically asking, just pick one or two of the biggest companies in Canada, question mark. If we invest in foreign stocks in an IRA, we do not have to pay 15% foreign withholding tax on dividends. So that sounds very similar to my RRSP. So I buy SCHD in here because I'm not paying over the border withholding tax. So these dividends are purely mine and they're just being reinvested. So that's why I focused more on SCHD in here. But if you're a US citizen, if it works the same way it does in Canada, you can pretty much just buy any Canadian stock you want. It'll just auto convert in your account. It should just come up when you search up the company. But you can see in my TFSA and most of my portfolios, I sever them off. So I open up 2 separate accounts in my brokerage account. So this is a Canadian account here, and this is a US account. So this side of my TFSA operates in US dollars, this side operates in Canadian dollars, and I would presume you can do exactly the same in the US. I don't think it matters if they don't trade on the New York Stock Exchange, but most Canadian companies I would want to buy do trade on the New York Stock Exchange, which I believe TD, Royal Bank, they have US counterparts. I think Enbridge does. I think most of the large caps do. If you're looking for ETFs specifically like XIC, XIU, those kind of companies, you should just be able to look them up and buy them straight within a US account. It'll just convert to Canadian dollars automatically, because that's what they do. Even if I'm buying them in a Canadian account, if I buy US stocks like Apple in a straight Canadian account, it'll just auto convert it and it'll just sit in a Canadian dollar account. What makes the stock market gains, capital gains versus income when it comes to taxation in Canada? Fairly straightforward. Canada is amazing for making money here, tax-free. The TFSA is 100% tax-free dividends and capital gains, but in a regular brokerage account, if dividends are made in Canada from a Canadian company that produces 50% of its revenues in Canada, you're only taxed like, I think it's a tax credit you get for, and we're only paying like 15%. Whereas with capital gains, it's much better. You only pay your nominal income tax bracket rate on 50% of the earned income. So 50% of capital gains are 100% tax-free. So it's mostly more better to focus on capital gains outside of tax advantaged accounts. But again, even if you collect dividends in a regular brokerage account, every year you could just contribute them to your RRSP and completely waive any income tax on them. Like, we get so many tax benefits from investments, right? Now, Anthony's saying, I'd like to see a video on different income streams if you're comfortable with it. So this is something that I'm primarily just focusing on my Patreon account because I do multiple jobs from my income standpoint. I actually have a full-time job that I do now. I run this YouTube channel. I do website stuff and so many other things in between. In fact, I just got a decent raise at my job, which we'll discuss more about on my Patreon if you're more about the personal finance side. I'm going to leave my Patreon link down below. It's like $5 a month. It's less than a Starbucks coffee. You get into my WhatsApp group where you can talk with me 24/7, 7 days a week, along with other 6- and 7-figure investors. But I'll pass that question off to you. I'd love to know what you guys think about everything we discussed in that comment section below.